All right, thanks everyone for joining us. My name is Brad Stewart. I'm the Associate Director of Investment Management Research. I'm lucky to be joined here today by Gil Loria, who's the Director and Head of Managing Director and Head of Technology Research for DA Davidson. Welcome, Gil. Thanks for joining us.
Thanks for having me.
So, in the past few weeks, I think that there's been a lot of concern about an AI bubble forming, and I think the question that we get and we talk about inside of our team are some of the risks around this bubble that could be this bubble popping. Usually saying something around the idea that there's not an ROI on the investment that these major cloud companies are putting into place, and the foundation models are putting in place, where they can self-fund this, or that there's maybe some questions around other sources of capital or just physical constraints in the environment. Which of the three do you think are worth being concerned about, and what's maybe overblown?
Well, I would say that, first of all, the framework we use is to just say there's healthy behavior going on around a really important technology that should have very broad positive implications for the economy. And then there's unhealthy behavior. Where we worry about the unhealthy behavior, to your point, is financial leverage. It's companies getting ahead of their skis. It's stocks of marginal participants with long-term promises getting overvalued. Those are the places that we need to be wary of. But the main participants, Microsoft, Amazon, Google, buying chips from Nvidia, running AI models, renting them out to their customers, there's nothing wrong with that. Microsoft, Amazon, and Google are very smart investors. If they're building out data centers, it means that they're getting orders from their customers to build data centers. And if they end up overbuilding data centers, that's okay. They can pause for a couple of years, absorb the extra capacity, and they will be just fine. Other companies that don't have the capital, that are borrowing capital to build facilities without having customers, and are seeing their stocks bid up to these exorbitant levels, that's where we worry.
So some of these companies that have to raise capital are customers of Microsoft and Google too, aren't they? Are we seeing a spread of OpenAI into using these other players too? Is that any source of concern?
So OpenAI is at the heart of a lot of the bad behavior.
Mm-hmm.
OpenAI, which by their latest statements have a $20 billion a year run rate. That's great. That's amazing from a standing start 3 years ago, but they're also going to lose tens of billions of dollars this year. And they've gone ahead and made commitments totaling $1.4 trillion by their count. Clearly, they can't live up to that. The likelihood of OpenAI growing fast enough for long enough to be able to live up to all those obligations is very, very low. Now, that doesn't mean they won't continue to buy compute from Microsoft. They still have a very good model, and the ChatGPT is the most popular chat, at least for now. So they'll continue buying compute from Microsoft. But even if they don't succeed, Microsoft will still be able to sell that compute capacity elsewhere. So Microsoft will be fine either way. Companies like CoreWeave that are building up their entire capacity for OpenAI, and doing so by borrowing very expensive debt, them I worry about. If OpenAI shows up tomorrow and says, you know what, you weren't able to deliver your promises in Q4, we already have more capacity coming up at Amazon and then at Microsoft, we don't need you anymore, CoreWeave. CoreWeave goes bankrupt. And $50 billion of market cap get blown away. The $20 billion of debt gets marked down to pennies on the dollar, and Microsoft will buy the scraps back from the scraps of data center that are left, again, at pennies on the dollar. That's bad behavior. And OpenAI is driving that bad behavior by making promises that it knows there's very little chance it can live up to.
Do you think that the ROI that the providers of this capacity, you say somebody else is going to take it up, the interest in using AI seems to have, the user base is growing, activity is growing. But is the ROI there for companies like Microsoft to reinvest the capital in that space, or are they just going to have to cut costs and find other ways to fund this or tap debt markets to do it for the time being?
Yeah, I think that's the right question. So we can have a nuanced conversation about ROI, because let me start with a broad statement, which is, as society as a whole, the economy as a whole is not getting a sufficient return on investment on the hundreds of billions of dollars that we've invested. That's still a true statement, before I say that Microsoft is getting a very good return on investment, right? Because Microsoft is buying the chips, it's turning around and it's renting that capacity out to its customers, mostly business customers, and they are getting a good return on that. And they'll continue to get a good return on that because they have all the customers. Those customers are actually increasing their, accelerating their orders for more compute capacity into the future. It is a profitable business for Microsoft, and therefore Microsoft is generating a good return. Now, are those customers that are deploying AI tools getting a good return on investment yet? Absolutely not. Which is why the overall system is not getting good return on investment. So what we have to pay attention to is, are Microsoft's customers getting a good return on investment? In which case they'll continue to order more compute capacity from Microsoft. The answer to that is still no, but the fact that those companies are going back to Microsoft and ordering more and more capacity tells us that those companies see a path to using AI to such a beneficial extent that they will generate those returns in the future. And so that's where we're at right now, where Microsoft, Amazon, Google getting good returns, Nvidia certainly getting good returns, but the rest of the economy believes, based on what they're doing with AI, that they will get those good returns in the future. Whether that materializes or not will determine whether or not we continue this the great data center build out past next year into the year after that and the year after that.
So one company that did seem like they were getting a good return on their investment, and or at least was being encouraged until just recently, was Meta. Why do you think Meta's been treated differently than these other large players?
So Meta is a little bit different here, right? So they're the same in the sense that they have a great business with tremendous cash flow, cash on hand, and the wherewithal to use it. They're different in that they don't have business customers renting out the capacity. So they are getting a very good return on investment in the sense that they are getting extraordinarily good at selling us ads. They're serving us better streams, better feeds. They're finding better spots to add for ads. They're serving better ads in those spots, which means they can charge more for those ads. So if you look at overall, Meta grew 25%. This is a very big business that grew 25% last quarter. That's an acceleration from 22% the quarter before that, which was an acceleration from the quarter before that. So they deploy AI tools to make their product better, which is a good return on investment. The reason Meta's stock reacted so negatively is that Mr. Zuckerberg is going out and saying, you know, I know I'm growing revenue 25%, but I actually need to grow CapEx and operating expenses even faster than that, to these gargantuan levels that clearly go beyond what he needs in order to sell more ads. And it's more him trying to participate in this game of ramping up towards the building out of super intelligence. And so that's what investors reacted to. It's like, Mark, you have 25% bigger budget next year. How about you spend that? And he's coming back to investors and saying, no, that's not enough. I need to spend even more than that next year, and I don't really care what you have to say, which investors usually don't like.
Does that speak to some sense of like an existential risk here that some of these companies face? I mean, there was a quote from one of the CEOs saying that the risk of underspending is greater than the risk of overspending, and that kind of speaks to an idea that maybe they don't see a great return on the investment, but they know that if they don't spend the money, it could hurt their business. Is there any sense of that Meta is facing a more of an existential risk than the others, or that anybody in the space is maybe facing an existential risk?
Yes, that is part of the equation. Let's talk about what the scenarios here are. There's a pessimistic scenario around AI that says, yeah, they're kind of cute. It's a cute tool. I use it for some stuff. It's not going to be that meaningful. maybe it's a big technology wave, but it's not going to really matter that much. We don't subscribe to that, even though that's a lot of the popular narrative right now. There's an optimistic scenario that says AI is a truly transformational technology that's going to drive huge gains in productivity, so much so that it will accelerate GDP growth. We subscribe to that. So does Mr. Nadella at Microsoft, Mr. Pichai at Google, Mr. Jassy at Amazon. That's the camp they live in, a very optimistic scenario that's worthy of a lot of investment. Then there's the maximalist camp. This is a camp that believes that we may be only a couple of years away from superintelligence. Superintelligence defined as an AI tool that can do any task a human can do better than any human. And if that happens, most of our businesses will become quickly useless, right? Most businesses will be able to get done by an AI tool, and we'll all become obsolete. Mr. Zuckerberg subscribed to that maximalist view. By the way, so does Mr. Musk at Tesla, and certainly Mr. Altman at OpenAI believe that we are a couple of years away from superintelligence, and therefore no investment that you can make could possibly be too big, because if you're not the first to superintelligence, you might as well be last. And that's what Mr. Zuckerberg is doing. That's why he's investing so much, is that he believes that if he's not the first to superintelligence, somebody else will get there and make his business obsolete. That's still a minority view. It's popular in Silicon Valley, but most of us, myself included, our team included, lives in that middle ground of being very optimistic without believing that we're going to make a tool in a couple of years that'll make us all obsolete.
Right. And I want to go back to, I want to go deeper into that. But first I was going to say, so is it fair to say that as far as the workloads and the demand that's out there right now, that the industry is by and large capacity constrained? There's too few GPUs, and there's definitely more than enough demand kind of to go around for all these players right now. So there's clearly the opportunity for this capacity to be put to work.
Absolutely. Both at a consumer level and at a business level, the demand for compute is larger than the compute we have available. And we know that because, again, these big companies that have all the customers, Microsoft, Amazon, and Google, just told us a couple of weeks ago that they don't have any build outs that are not already sold. They've already sold their capacity for years into the future in terms of compute to companies that are asking for that compute in order to get what they want done. So we do need a lot more compute than we have, and there are companies that are willing to pay for it and make long-term commitments to pay for it right now. So we know that's the case, which is why we see the behavior from Microsoft, Amazon, and Google as being mostly responsible.
Do you think that there's anything to the physical constraints? I know that power is often talked about, rare earth elements. Like, is that something that should be on people's radar too, but maybe is not quite as big a risk as the other three that I mentioned?
There are bottlenecks. Yeah. There are risks in the sense that a lot of these companies won't be able to build out capacity as fast as they want, but there are a lot of bottlenecks. Power is one of them. The equipment, cooling equipment, HVAC equipment is another. Labor is a huge one. If you're an electrician right now and you're willing to get on a plane, you can make at least twice as much as you usually do by working at a data center. Same for HVAC technicians. We don't have enough trained HVAC technicians and electricians to build out at the rate that we want to. Power is an issue. We don't have enough capacity on the grid. What these companies are doing when they build out data centers now is putting power, what they call behind the meter, meaning just bringing a generator and a turbine to produce power that's not even tied to the electricity grid, because the business is so lucrative that it's worth it for them to do. So there's ways around these bottlenecks, but all of these bottlenecks are impacting the rate at which we can build out data center capacity.
And kind of keeping the market at least constrained for the time being for the capacity. Right. And so I want to talk about that base case that you talked about, the idea that AI, this Gen AI is a general purpose technology that's going to diffuse through the economy and create large benefits. Um, how how does that look from an employment standpoint and a GDP performance standpoint? Do we have any good indication from any of these businesses how to think about the productivity benefit and the growth to GDP and how it would reshape the labor force in a 5-year time horizon?
Up until now, we have anecdotal ideas of how that's going to work out. But let me first put the frame this way. Most technology, when it comes in, new technology that's come in over the last several years, it's our IT organizations that implement it. And so the market for technology is usually constrained by IT budgets. AI is different. AI, it will increasingly become competition for labor, or a participant in the labor market. And the labor market is obviously tens of trillions of dollars. And this is why these companies are getting excited. And all you have to do is look anecdotally. People talk a lot about software coders. We can talk about that, or call centers, but let me give you a better example, which is my friend, the lawyer, who has her own law firm. And increasingly, instead of hiring associates and paralegals, is using ChatGPT, because ChatGPT can read a deposition and summarize it for her. It can extract information from her files. In fact, she's using it to develop trial strategies. She's testing out trial strategies and asking ChatGPT to tell her if what to work on if she pursues a certain strategy. That's instead of hiring more associates and more paralegals. Now, what does that mean? That means pressure on the labor market. It also means that people in the labor market, people that are good users of AI, will be that much more valuable. We are not going to be replaced by AI. We're going to be replaced by people that use AI better than us. That's the operative phrase, at least for the foreseeable future. And so what that means is the employment market, it'll take some pressure off the employment market, meaning we won't need as many people coming in, but the people that are employed and that do get leverage from using AI tools will become so much more valuable that their compensation will go up. If she doesn't need to hire more associates and paralegal and can handle more trials and more cases, her firm will get paid more money and have less expenses. She will be producing more towards GDP. She'll be able to pay the existing people she has more. She'll take in more profits. That's the model that we're going to increasingly start seeing in the economy. So again, not great for new employment, but for people that for the people in the labor force that are adept at using AI tools, this could be a huge productivity enhancer and therefore enhance their earnings abilities.
Is there any indication that AI is going to create, or there's going to be new jobs created from it? Like some technologies do that, and it would seem that that would be one of the things that would need to come from a productivity enhancement like that. Otherwise, it seems like there's going to be a large rise in unemployment. Is unemployment the most likely, a rise in unemployment, the most likely outcome in this scenario that you're describing?
There are new things that we need to do because of AI. Somebody needs to create more data to train models. Again, operating the models, knowing how to use them, is a new type of job. So increasingly, the job will be, instead of reading a deposition and summarizing it, it'll be working with a model to read hundreds of depositions and summarize them. So the job changes a lot, but it'll still be there. Again, our throughput for the economy will increase substantially. The employment that will fall off is mostly people that don't adapt to this new way of working. So it could increase unemployment. It's a little too early to tell, but in the short to medium term, it should just increase productivity a lot.
Okay. And so I'll end it with, what are your favorite ideas in the space?
Microsoft will work in any environment. Amazon, will work in almost any environment. Nvidia will sell chips along the way. Um, on the software side, you can see on the board behind me, we like infrastructure software stocks, companies that are already doing well, and AI just creates an even bigger market for them, like Snowflake or Datadog or Dynatrace or JFrog. These are companies that are now have accelerating growth because the more we use AI, the more we need the software that supports code writing and data management and observability of applications. So we like those types of stocks as well.
Terrific. Well, Gil, thank you very much for the time.
Thank you.